everyone to the session today. My name's John Versace. I'm the head of expat services and a senior financial advisor here at Apt Wealth Partners. Today's session is all about retirement planning for US Australians. So just get my slides to work here. Yep, so retirement planning for US Australians. So whether it be superannuation in Australia or 401ks or IRAs in the US, these retirement vehicles are all designed to be a tax-effective savings pool. But when you throw cross-border taxes into the mix, things can get a lot more complex. So we're here today to try and break down some of the complexity and work through some of the do's and don'ts when planning a cross-border US-Australian retirement. So really lucky today to be joined by my co-hosts, Kendra Wong and Brad Murphy. So Kendra and Brad are the absolute gurus, the dream team of US Australian taxes. So welcome, Brad. How are you doing?
Thanks, John. Thanks for the kind words. It's very nice of you to say that.
Welcome, Kendra. How are you today?
Good morning. Very well. Thank you.
That's good. That's good. So just going through the formalities. So today's session is general in nature. We obviously haven't considered your personal circumstances in providing today's session. So please take it as general advice. And if you are looking for personalised advice, please reach out to one of the co-presenters today or a suitably qualified professional. We are recording today's session. So if you need to take off early, you'll get a recording within the next week or so via email. You'll also see a Q&A button in your screen there. So please feel free to ask any questions along the way. We'll endeavour to get to as many of the questions in the session today as we possibly can. Anything we can't get to, we'll try and come back to you via email or certainly give you a point of contact so you can come and speak to us about your specific query, and we'll see if we can help. So just introducing ourselves. So as I mentioned before, I'm John Versace. I'm the head of expat services and a senior financial advisor here at Apt Wealth Partners. So Apt Wealth is a broad financial advice firm with offices in Melbourne and Sydney CBDs. We look after around about $3 billion on behalf of our clients. We've got 80 staff, and I head up our expat services team, which is a specialised team that looks at cross-border situations. And we've got a huge amount of that clientele, and the cross-border team is a US Australian. So either US citizens living in Australia or Australians living in the US, because as you know, and as we're about to find out, there are some complexities that do require the specialist knowledge when working through financial planning for US Australians. So Brad, do you want to go through a bit about yourself?
Yes, thank you, John. Yeah, I'm a director at Murphy Tax Lawyers and Advisors. We're a specialised Australian international tax firm, so we focus on providing expat tax advice for expats around the world, but we have a particular focus on the US and Australian market in particular, and work very closely with firms like yourself and Canberra to provide integrated tax and financial advice across both countries. A bit of background about myself. I used to work with a couple of big firms, Deloitte, before starting my own firm back in 2019. We've got 12 staff across Melbourne, Sydney, and the US.
Beautiful. Thank you for that. And Kendra.
Thank you. Again, my name is Kendra Wong. I have been doing US tax returns for 20 years now, which I still am shocked to say that this is my anniversary year. I started my training in the US when I worked for KPMG in California. And since then, I've moved around, very lucky to be able to work with the population of US citizens and people with US tax issues in the UK as well as in Australia for 10 years now. So seen a lot, done a lot, and very happy to be teamed up with John and Brad to really provide that integrated service that Brad mentioned that I think is quite often missing in this space. So yes, very, very happy to join today, and thanks for the opportunity.
No, beautiful. And more on that sort of integrated process is that Brad, Kendra, and I really do seek out to try and provide a holistic service for our clients. There is, overlap between our services, and if you've got professionals that aren't speaking to each other and aren't on the same page, things can get really messy very quickly and really complex for the client. So we really want to make sure that we work together with our clients, and we work as a bit of a team. So, joint meetings where appropriate, and consolidated advice and services. So it's something that we think is missing in this US Australian space, and something that we're really seeking to provide is a really consistent consolidated service across the wealth management and financial strategy and the US Australian tax side of things. So please feel free to reach out to us if you want to discuss more. But getting into the session today, so we're going to start off with superannuation and talk about firstly the Australian tax treatment of super. So I'll go through that quite quickly, because this is probably the easy part, and then we'll talk about the US side and how that unfortunately interferes with some of the things that super is designed to do. But ultimately, super is one of the highest rated retirement savings vehicles in the world, and you'll see why with the treatment here. So superannuation, there's really two ways you can get money into super, or two main ways. It's before tax, so money that goes in by your employer or anything you salary sacrifice into your superannuation. It's taxed at 15% going in when it's pre-tax dollars. At the moment, there's an annual limit of 27,500. That's about to increase to 30,000 in the 24-25 financial year. You can actually go back at the moment. So if you haven't capped out your super and done the maximum 27,500, if your balance is under 500,000 at the start of the financial year, your total superannuation savings pool on an individual basis, you can actually go back and use the unused portion of your previous contributions going back to the 18-19 financial year. So this is a really powerful strategy for, especially an expat coming home. So an Australian coming home from the US, you haven't been contributing in previous years. You can actually go back and use the unused portion of the previous 5 years and get around about $130,000 in before tax into your super, which can be a really good way of minimizing your taxes on your return home from the US. So that's something to bear in mind for expats coming home, and also Americans moving to Australia where it makes sense. Now, we'll wait to hear what Kendra has to say about some of the contribution strategies, but it can be, from an Australian tax perspective, a really good way of getting money in quite quickly, and really minimizing your tax in a particular tax year. There's the second way you can get money into super is a non-concessional contribution. So this is your after-tax dollars, money you've already earned and paid tax on, income tax on. You can put up to $110,000 per annum in at the moment. And you can also bring forward the next 2 financial years. So, if you're putting in 110,000 this year, you bring forward the next 2 financial years and put in 330,000. And it just means that for the next 2 years, you couldn't put any more of any after-tax non-concessional money into superannuation. And this is per individual. Next year, the limits are increasing, so you'll be able to do 120,000 of after-tax money, and then bring forward the next 2 years, so you get 360,000 into super, so long as your total super balance is below the 1.9 million at the moment. So you can get quite a lot of money into super quite quickly. The tax on earnings within super is taxed at a maximum of 15%, typically. So very low tax on earnings. And then the drawdowns in retirement. So when you commence account-based pension after the age of 60 or 65, when you're retired, you essentially create a tax-free environment from the Australian tax standpoint. So all the tax on earnings become completely tax-free, and anything you draw out of superannuation from an Australian tax standpoint is completely tax-free. So all sounds really good from an Australian tax standpoint, but there are a few things to be careful of. Firstly, Brad, do you want to go through maybe a little bit about SMSF for Australian non-residents, and then we'll kick off the bad news and get on to US tax with Kendra.
Yeah, thank you, John. Yeah, just quickly before I pass over to Kendra, Just be aware for Australians to have a self-managed fund in Australia, which is obviously quite common for Australians to hold, property, commercial property or a business in a self-managed fund in Australia. Just be aware that if you do become a non-tax resident, so if you move to America, that fund can be actually non-complying if you actually live in the US for more than 2 years. So the ATO, they allow a 2-year grace period effectively where you can have a self-managed fund with non-resident trustees or directors, but after that 2-year period, it's actually, strictly speaking, non-compliant at that time. There's quite a nasty tax on the growth of that fund at that time. But I guess the ways you can get around that issue would be to have an Australian director appointed by way of a power of attorney before you go, or consider rolling those funds to a retail fund before you move to America. But just be aware of that. It does get overlooked sometimes as well.
Yeah, no, really, really good points, Brad, and we've seen it as well, unfortunately. So definitely plan before you move and have a look at where your super is. But Kendra, getting over to the fun stuff of how the US treats superannuation. So throw over to you.
Always of bad news, unfortunately, but there is quite a lot of complexity with how the IRS, the Internal Revenue Service in the US, views superannuation. And quite frankly, there is a lot of unknown quantities because the IRS hasn't really ever specifically given guidance on super. They talk a lot about foreign pension schemes and this and that and the other thing, but none of their guidance addresses super, which is such a unique system in the world. And unfortunately, the US-Australia tax treaty is as old as I am and hasn't been renegotiated in that period. And so we don't have a lot of guidance from the treaty either. So it leads to, I guess, some gray area. But what I'd like to walk through today is sort of my understanding and my perception of how the IRS treats super. And there's quite a few things to go through. I'll try to get through them as quickly as possible. But when I'm evaluating superannuation for a client, there's 3 main things I look for. So number 1 is who is contributing, excuse me, who is contributing to superannuation. If we are talking about employer contributions, superannuation guarantee, the 10.5% or 12% contributions being made on behalf of an employer. My starting point is that is actually taxable income from an IRS point of view. What it means is that we are looking at taxing the total REM on the US tax return, unlike in Australia, where that superannuation guarantee doesn't really hit the Australian tax return. And I'll come back to why that's important in a moment. The second thing I look at is what is the salary of the person in question. The IRS has a concept of what's called a highly compensated individual. And the number changes every year, but right now, an individual who's on a salary of 155,000 USD or more is considered highly compensated. And that changes the calculus a bit because instead of looking at what the employer is contributing to superannuation, we look at growth in super. So what is the balance on December 31 of the taxation year? Convert that to USD at the spot rate. Comparing it to what was the balance at January 1, converted at the spot rate. If there's growth in super, it's taxable on the US tax return. And of course, if it's a loss, it is not a deductible loss. That's the generosity of the IRS, I guess. And then the third thing I look at is, do we have a self-managed super fund involved? And I'll get to that in a moment. Or what is the quantity of personal contributions made to superannuation? So I guess in some ways, the IRS looks at it and says, look, okay, if this is an employer-funded scheme and it's locked up until you're 65, that's all right. You know, report some income, report it on the SBAR or the other informational forms as required, and that's about it. Unfortunately, when individuals have made a lot of contributions to the extent that they exceed what employers have put into superannuation, it raises another issue, which is called a foreign grantor trust issue. In the eyes of the IRS, they just assume that instead of a locked up retirement account, the individual is funding this account to create their own investment vehicle. And that investment vehicle is, again, a foreign grantor trust, which means that the earnings, accretions, growth, capital gains on that portion of the contribution is a look-through vehicle from a US tax perspective. It means that that income is reported directly onto an individual's US tax return via a set of forms called the 3520 and 3520A forms. These trust reporting forms are quite complicated, quite expensive to produce, and can really cause a lot of complexity on a US tax return. A self-managed super fund, which Brad touched on before, would also be treated under these foreign grantor trust rules because, of course, you are literally establishing your own investment vehicle at that point in time. Going back to this idea of including income on US tax return, not the end of the world. Australian tax rates are very high compared to US tax rates, and including, 11%, of additional income on a US tax return rarely results in actual tax owing to the IRS. But what it does is essentially create a cost basis in superannuation. US citizens and green holders or people that are living in the US when money comes out of superannuation don't get the same deal that Australians do. It is a taxable event upon distribution. So we have a terrible mismatch between the two systems where tax is paid going into the fund in Australia, and then tax has to be paid again coming out of the fund at retirement age. And the only way we really have to mitigate that is by looking at all of that income that we included on the US tax returns in the prior years and calling that our cost basis that cannot be taxed again by the IRS. So you essentially are in a position at retirement age of having the growth in your super be taxed by the IRS. So that is the very bad news that I always have to share when I'm speaking to people who have a connection to the US as well as superannuation. So.
Beautiful. And I'll just get my, there we go. So you mentioned about the foreign grantor trust.
Yeah.
Kendra, was there any more to add on that?
Yeah. Definitely. Thanks, John. The problem with a look-through entity, as we call it, like a foreign grantor trust, is that not only do you report the incomes and the gains, as I mentioned, using those special tax forms, the IRS drills down even further. So where did these gains come from? Quite often, it's from this concept of mutual funds in Australia, ETFs, managed funds. There's a whole set of popular investments in Australia within superannuation that would be caught up in these rules called the passive foreign income. I can't even talk this morning. Sorry, passive foreign investment company rules, or PFIC rules. And those PFIC rules are essentially anti-avoidance and a deterrent. The IRS doesn't want people investing in these types of assets. So to add insult to injury, when you have a self-managed super fund or a portion of your super has been overfunded through personal contributions, you have to follow these PFIC rules as well. So more compliance, more cost, more complexity when you file your US tax returns.
And so I guess just talking through some of the strategies at a very high level, of course, so it's going to be different for every individual and where they are in the world, whether they're an Aussie in the US or a US citizen living in Australia. But, a few of the strategies that we might see, if we all might want to go through a few of these. So I mentioned before about the temporary resident in the US, you know, an Australian resident in the US coming back to Australia. Kandra's mentioned about the complexity of adding superannuation contributions and the way the US may perceive super if you are to add, you know, some large contributions to super. So, you know, I guess the timing of coming home and making those contributions, that's a, you know, so for an Aussie that's just on an E3 visa, for example, or a temporary US visa coming home, they extract themselves from the US system. There is a lot of opportunity to get money into superannuation. So the catch-up contributions going back to 5 previous financial years, which you can get, you know, the 130,000 or so in very, very quickly by catching up the previous 5 years. Plus those after-tax contributions, you can get significant wealth into super. So it may be a matter of just timing for an Australian coming home and waiting until you get out of the US system when, you know, you don't have the US treatment of those contributions and you're free to, you know, utilize the full power of superannuation at that point. So that's the first strategy to look at. I think we've probably covered off the grantor trust, Kendra. I think that did you maybe want to go through about a non-US, so you know, looking at an American citizen here with a non-US partner, you know, that treatment there.
Yeah. And Brad, please definitely jump in with some comments on Australian side, but there is definitely the opportunity for a US citizen to get their money into the hands of their non-US citizen partner, whether that's de facto or legally married, which is a very important distinction for the US tax system, believe it or not, through a strategy which we call gifting. So basically giving your partner a sum of money every year or at certain points in time for them to contribute to their own superannuation. There are limits on the reportable amount of gifting. So depending on your relationship to the person that you're giving the money to, the gift may need to be reported to the IRS, but it's very unlikely that it would be a taxable event on the US side. So Brad, I don't know if you have any comments about that strategy.
Yeah, for sure. I think just to reiterate what you both mentioned was that catch-up contribution is really helpful for temporary residents coming back to Australia, because you can get up to $140,000 effectively pre-tax to offset your employment income when you come back to Australia for the first couple of years, and that's really obviously advantageous. And I guess too, you know, why super I guess is so good for Australians, right, is that you know, as we all know, it's tax-free post 60, and the contributions are taxed at 15%. With earnings occurring at a 10% tax rate effectively in the fund. So it's always recommended, to the extent you can from a tax point of view, to have assets and investments in that super environment. So I think that strategy of utilizing the non-US spouses super is really quite effective. A couple of other points would be too that for temporary residents coming back to Australia, there is some upshot there from a capital gains perspective as well, and maybe utilizing a family trust at that time. The reason being is that any US investments that you've held or, you know, acquired since you've been in America get rebased their fair market value when you come back to Australia. So effectively, you're just paying any capital gains tax on the increase in the value of those assets when you come back to Australia. So you can sort of get a nice outcome there by almost quarantining any gain that's accrued while you've been in the US. And at that time, you've got the option to move those investments to a family trust in Australia, which can be quite effective, especially if one spouse is not a US taxpayer. Then you can effectively keep that trust outside the US tax net. And obviously, Kendra can give you some more advice around that. But normally a family trust is a very effective sort of vehicle to utilize income splitting once you're back in Australia as well.
Yeah. The last point there, Kendra mentioned that there is some real complexity around, you know, foreign grant or trust from a US tax perspective. There can be a world where you may want to consider triggering it, and it may be, you know, a US citizen with high net worth in Australia. where, remembering Australia is a very, very high taxing country, and from a federal level, a much higher taxing country than the US at a federal level. So, it can work where, you're at the top marginal rate in Australia, 47% tax on earnings, and, you ordinarily would be utilising superannuation to try and lower the tax on earnings, and, potentially, triggering that foreign grantor trust where it's going to have a significant benefit in Australia. It won't provide any benefit in the US, and in fact, it's going to make things a little bit more complex. Quite a bit more complex with the US and reporting. You've got to be very careful what you invest in within your super, as Kendra mentioned, because of the PFIC rules. But you could certainly invest in very clean investments from a US perspective, and ultimately, just looking at your worldwide position, bring down your total tax, even if it means that the US is a little bit more complex. But tread very, very carefully in that space. Get advice from advisors and accountants that know what they're doing there. But that's, I think, in a very limited circumstance. For 95% of the population, it won't work. So that's something. Please seek further advice if you want to discuss that a little bit further, if you're a higher net worth individual. But going into US retirement treatment, Kendra, did you maybe want to go through a bit about the US tax of US retirement accounts?
Yeah. Today's seminar will just touch on the three very common US retirement accounts. There are a ton. It seems like they're adding new ones every year, but these are the three that we see most commonly. So on the slide here, 401k and traditional IRA. A 401k is something that is offered by a US employer. You can't participate in 401k unless you are an employee and on US payroll somewhere. But essentially the idea there is that individuals can make contributions to 401k plans on a pre-tax basis. So that means if you're on a $100,000 salary, you can make a contribution up to the IRS limit that's set each year, let's call it $20,000. You would report and pay income tax on the $80,000 remainder. Traditional IRA is similar concept. It's usually funded with pre-tax dollars. So there's lots of subtlety there in terms of income thresholds, but the idea is that you make a contribution, you get a deduction on your current year tax return. And by funding these plans with pre-tax earnings, it means when you hit retirement age, the distributions come back to you on a tax-free basis. So I think the American mentality is, by the time you reach retirement age at age 59 and a half, you stop working, your income tax rate goes right down. And so, having a mix of income from taxable investments and this tax-free type of income provides people with a good outcome at retirement age. As the slide mentions, US citizens, green card holders, or US residents, there is a distinction between taking your retirement funds out over age 59 and a half or under age 59 and a half, which would result in an early withdrawal penalty. And later on in the conversation, we'll talk a little bit about non-US residents. So no green card, no citizenship, people back in Australia who take money out of their US plans. It's a slightly different scenario. So that's the 401k and the traditional IRA. The Roth IRA is the next most common plan you see. It is funded with after-tax dollars. So after you've paid your income tax, you stick some money into Roth IRA. So, sorry, I think I said it backwards. Sorry. Pre-tax contributions, you get taxed at retirement age. Pardon me. I think I said that backwards. Post-tax contributions like a Roth IRA are tax-free after retirement age. So as I was saying, you get a nice mix by participating in the various types of plans that the US has to offer. just be aware, US citizens that are living in Australia, your ability to contribute to traditional IRA and Roth IRA will depend on your individual circumstances and what type of income that you do have coming in and how you choose to report that on your tax return. So it's not a slam dunk. You need to get some advice before you start making contributions to the non-401k plans.
Yeah, beautiful. So, Rat, over to you in terms of the Australian tax treatment of a US retirement account.
Yeah, thanks, John, and thanks, Kendra. Yeah, so again, unfortunately, Australia does not recognise US plans as super in Australia, given the very old 1983 tax treaty didn't quite update that. But if you look at it at a high level, right, Australia would effectively say that Australia would tax the growth component of a US plan, so a US 401k or IRA or Roth IRA. Australia would say that on withdrawal of those plans, if you're living in Australia, the growth component is subject to Australian income tax. Now, that may sound like bad news, but the outcomes can actually be good depending on your circumstances, of course. In particular for temporary residents coming back to Australia, that's where the outcome normally can be quite good. So effectively, if you're not a US taxpayer and you're living in Australia, the tax treaty would allocate taxing rights only to Australia on the withdrawal. And Australia would just tax the growth component of those 401k or IRA plans. So the contributions that you put in or your employer has put in there is not taxable. And at the same time, a withdrawal would normally not be subject to US tax, which is obviously quite handy, that outcome. And although there's no direct way to get money transferred from a US plan into your Australian super through a direct mechanism, you can sort of do it indirectly through making those pre-tax concessional contributions. So from the taxable component of the IRA or 401k, you can transfer that component to your super by way of a pre-tax contribution. And the limits are, $30,000 per year, but you can use that catch-up amount as well. So there is a way you can sort of A, lower your taxes, and B, get the money into your Australian super indirectly. I guess where the outcome's not quite as good is for US citizens or US green card holders living in Australia, in that they will obviously still be paying US tax on the withdrawal in the US. Australia would say we'll give you a credit for US taxes paid, so there's no double tax there. And the goal there is really to mitigate and optimize taxes across both the US and Australia. So I think with US plans, it's really important to consider both countries' tax positions, not just the US and not just Australia, and look to optimize and mitigate taxes in both countries. And that's normally a combination of doing a multi-year drawdown over a number of tax years to avoid a lump sum in one income year. Look to put money into your Australian super when you can, especially for non-US residents. And then look at, I guess when you need the cash, is it a lump sum for a house deposit, or are you happy to wait for retirement from a sort of financial planning perspective? Yeah, just one more point too. I can see there's a sort of question mark there in the slides in terms of a rollover. There may be some benefit to doing a rollover from a 401k to an IRA before you actually come back to Australia. So there has been some guidance from the ATO to say that effectively, if you do a rollover from a 401k plan to an IRA before you actually land in Australia, that can reset that cost basis or capital component of the plan. And I guess why that's helpful in layman's terms is that you would just be subject to Australian tax on the growth over and above the rollover value, as opposed to the original contribution amount from your employers. Now that's a complex area, and certainly just make sure you get some advice before you undertake that approach.
Yeah, beautiful. And there's no, just to make absolutely certain and clear, there's no ability to just move your 401k to superannuation or vice versa. They unfortunately very different to like a UK scheme to Australia. That there isn't really the ability to do that because of that distinction of the way the 401k and the mismatch between the two systems ultimately. So
Yeah, just one more point there too, John, and sorry, and Kendra will jump in a second as well, I'm sure. But even though we say for a temporary, resident holder in Australia, there should be no US tax on withdrawal. We find the US funds sometimes still withhold taxes on withdrawal in the US at 30%. So if that happens, it'll be a case of filing a US return to try and get the money back from the IRS, and that's where Kendra can help out in that regard.
Yeah.
So don't lose faith. If the fund does withhold 30% tax, you can still hopefully get it back by filing a US return.
Yeah. So in terms of the strategies, might have covered off a few of these, right? But with an Australian living in the US, sometimes we find that they're a little bit reticent to be contributing to the 401k. They're a bit scared of how it's going to be treated coming home to Australia and the complexity of it. But quite often, and I don't know if Brad or Kendra, you have any contrasting views, but if we're looking at it as going in completely tax-free, 401k contribution, it's money going in tax-free, so it's an immediate tax benefit in the US. Quite often there's a matching, so you won't get that extra benefit unless you're contributing to the 401k. So it's really money that you won't get unless you're contributing. And then there's earnings that are earning completely tax-free as well. It is usually something that makes complete sense to contribute to, just given those those benefits. Yes, there might be a little bit more complexity when you come home to Australia, or you move to Australia, but it's a pretty good deal you're getting from being able to contribute and still have the earnings, not taxed until you draw it. Do you guys have any sort of things to add or any additional thoughts?
Yeah, I agree. I think free money is always good money to take.
Yeah, absolutely. And I think you mentioned about when to draw down. There was a question about what's the latest age from a 401k or IRA that they make you draw down. I believe it's 72 now that you need to draw. So that's really strong consideration as well. And if you've got other retirement income sources, potentially delaying when you draw down the accounts, because again, it's growing, it's not being taxed until you draw it. So the earnings are just bubbling away without a tax. So it's it depends on circumstances and factors, but the latest age is age 72. And then a US citizen in Australia contributing to a US retirement account. That's a bit different. There's no Australian benefit. Australia won't recognise the concessional nature of you contributing to your US retirement accounts, and the Roth IRAs are unfortunately not as appealing in Australia, as Brad mentioned. So yeah, usually contributing to those the US retirement accounts from Australia, if you're a US citizen living in Australia, won't quite stack up. So any other things that you wanted to add, guys, in terms of strategies or considerations around US retirement accounts?
No, I think that's a good summary, John.
Summary. One topic that does come up, which is probably out of the scope of today's discussion, but when people are thinking about renouncing US citizenship, it quite often comes up with respect to this conversation about super. If you have been living in Australia for a long time and really planning on utilizing superannuation for retirement, the idea of getting rid of US citizenship and not having to report any of that to the IRS on a go-forward basis is quite appealing to a lot of people. So that's perhaps a strategy for some people.
Yeah. Okay.
Yeah, I think there's some questions too regarding when should I take out a Roth in Australia or the USA, and that's that mismatch that John and Kendra spoke about in terms of normally withdrawal from a Roth IRA would be tax-free to US taxpayers living in America. Unfortunately, Australia would not recognise that treatment and would tax it, on the growth component of that. So, I guess, what should you do about that? Well, I guess first off, just work out what the actual taxable component actually is in Australia. So, it may not be as bad as you may think. So I think before you sort of jump on a plane and move back to America to pull it out, it's important to, I think, just crunch some numbers around it and see what the impact would be on that withdrawal, because there's normally ways you can lower the taxes, especially if you're in retirement as well. It's not as bad as perhaps one might think. Yeah. Do you want to just touch on social security payments as well quickly, Kendra? So I'll quickly cover the Australian side. Good news on payments from US Social Security. They're not taxable in Australia, so you can ignore those.
Yeah. People that have worked in the US and contributed to Social Security via payroll contributions or self-employment taxes on their US tax return will be eligible for Social Security benefits. And that's true whether you're a US citizen or an Australian who just worked in the US temporarily. The US will tax Social Security benefits, but they will only tax 85% of those benefits. So if you're a non-resident of the US, you can have these benefits deposited in Australian dollars in your Aussie bank account, as long as the Social Security Administration is withholding 30% of 85% of those benefits. There's really nothing else to do from a US point of view. And for US citizens receiving Social Security benefits, of course, just make sure that they're reported on your US tax return each year. But as Brad said, not taxable in Australia at what's typically a higher rate. So quite a good deal for Social Security benefits. And don't forget too that Services Australia or Centrelink is also quite helpful when you're at the stage of considering whether to start drawing on Social Security. I find quite often they're a lot easier to deal with than the US Social Security Administration in Baltimore. So that's a good tip as well.
Centrelink love you drawing your Social Security, because it reduces the other benefits they need to pay as well, because it's all income and means tested. So that's the cynic in me, but they're very keen for you to draw your US benefits, because it's that means that Australia's means tested income test. It's and a really good point in terms of Social Security. There's actually a Social Security treaty between Australia and the US. Typically, if you do the 40 quarters of work in the US to qualify for Social Security, it can be potentially, you can qualify from doing less than that in the US and utilize some the quarters of work in Australia under the treaty between the US and Australia. To qualify, there's a few parameters around that, and it's usually going through Centrelink to qualified, but that's a benefit there that potentially.
I think people, if they're just in the US temporarily, they've kind of given up on the idea of Social Security. They just don't know that Social Security treaty exists. So that's the one time I ever get to give good news to the people that I speak with. But also US citizens who are considering renouncing, that's something that they're very concerned about as well. Well, if I renounce, can I keep these benefits? But you certainly can.
It's not not linked to residency, is it? And or citizenship, and
no.
If you log in through your Social Security login, or it's not going to factor in Australia and this treaty. So just bear that in mind, that it may not actually count any quarters of work, because they won't have any information about the quarters of work you've done in Australia that may count towards the US. So just bear that in mind as well. But that's a good thing between the two countries for sure. So just going through very quickly some of the broader considerations around retirement that we've covered off. Obviously, the tax side of things. One thing to point out as well, that the currency exchange risk is a big consideration for US Australian expats, and ultimately drawing your retirement income. So that's a really important point to consider. Looking at just very quickly, looking at the exchange rate over a long period of time, you see a lot of volatility happening there. So, you've got to just bear this in mind when you are funding retirement. And, you know, for example, if you were, you know, an Australian that's been living in the US, planning to retire back in Australia, but all your wealth is in the US, there is a risk that, you know, if this situation played out, that you all probably remember back kind of between the period of 2007 to 2015, where the Australian dollar was really elevated and was trading at parity for a long period of time. If that situation were to play out again, and you're drawing all your retirement savings from the US and bringing it to Australia to fund life in Australia, that's obviously going to be a horrible outcome for you, and you know, put you in a very tight spot. And then the reverse is true. Right now, you know, we're at around 65 US cents for an Australian dollar. The Australian dollar is quite weak. If you had all your wealth in Australia, but you're planning on retiring in the US, and you had to pull money from Australia, Australian dollars to the US right now, not a good outcome. So it's thinking through the currency in all of this, and planning ahead to just make sure you're not in a tight spot. You're not going to predict any of this stuff, because it's just the currency exchange. There's so many factors that influence it, and so many unknowns in the future. And it's looking at it from a risk management perspective. And that's what we encourage all our clients to do, is look at it from a risk management perspective, and kind of just hedge your bets if you, you know, you've got this cross-border retirement lifestyle that you're looking at. So, and there's potentially complexity in getting money into superannuation or into a 401k. So it's not ideal often when you're working through US Australian taxes and trying to plan a retirement. So sometimes it's building wealth in a non-retirement account. And, you know, it's not what you probably want, and it's not what, you know, if you're a US citizen living in Australia, it's probably not what your Australian friends are doing, but it may be the best of what you can make of this cross-border lifestyle. And so, you know, that's something we potentially look at, is building a wealth portfolio that factors in some of those treatments that Kendra mentioned, the passive foreign investment company. There are investments you can get around that treatment, and you know, we're talking very clean, direct company stock or US domiciled ETFs, and making sure that, you know, it's not going to cause a problem from a US tax perspective, but you can still build your wealth. And, you know, if you can't get these big lump sums into super, because it's going to trigger a foreign trust, there might be some other things you can look at. So again, a case-by-case basis, and you know, I think, it's not a one-size-fits-all, unfortunately, but it's there are avenues really for everyone. Ultimately, it's just making sure that you find your right avenue, and that's where, you know, the three of us and our teams can certainly help. So I think we're right on target to answer a few questions here. So please feel free. I've got quite a few questions in the Q&A, which is great. We'll go through a few of those right now, but please feel free to send through any questions, and we'll see if we can get to those. So Barbara just mentioned about the US Australian tax side of things that Brad and Kendra handle in terms of Apt Wealth and our services. So we're Australian licensed. We provide Australian advice around superannuation, Australian wealth. We do have solutions in the US that can look after the US side of things as well. So just got a cleaner in the background that wants to join the webinar. So welcome them. But the good timing. But we do, in the same way that we work with Kendra and Brad, we also work with professionals in the US and can bring them into the process and provide that holistic approach. So reach out if you need that there, but we do aim for a holistic approach across US, Australia, in both the tax and the wealth side of things. Now, there's a question in relation to, if you contribute to super in Australia after tax, do you get taxed again in the US if you are joint citizens? So maybe Kendra, do you want to go through that? Probably not.
Yeah. Yes and no. So again, this idea of establishing a cost basis by, you know, income that has already been taxed once by the IRS cannot be taxed again. But the timing again of being taxed by the Australian fund on earnings or contributions when money goes in, and then potentially 40 years later being taxed again by the US. That is well and truly double taxation. So yes and no is the answer to that one. Yeah.
Thank you for that. So just reading through the next questions. Super tax treatment. If an employee never contributed anything beyond compulsory super contributions and no contributions were made since becoming a US tax resident, and it's not an SMSF, does the taxpayer have to pay any tax on this as in the years prior to withdrawal, when it's just sitting there? If they are highly compensated in the US, do they have to?
Very technically, probably yes. And opinions will vary depending on who you speak to. And again, that's because of this gray area that the IRS has created without any hard and true guidance about superannuation. But yes, certainly there are firms and accountants who would look at superannuation growth every single year and report that component on a US tax return. That can definitely cause big issues. Quite often we don't have foreign tax credits available on the federal return to offset that. Quite often we have state taxing on that component of income as well. They generally don't recognize any treaties or the concept of foreign tax credits either. So yes, it is absolutely possible for that to happen. Yeah.
Yeah, that's a good question too. I think Lisa has raised that question regarding state taxes, Kendra, which we haven't touched on in a whole bunch of detail. But yeah, definitely a really important point to factor out or factor into your planning as well, because as you mentioned, the US states normally don't give credits for Australian taxes paid. So if you're selling an Australian property, for example, or you have Australian rental income from property or investments, then the New York and California state taxes can be pretty high on that income. So just be mindful of that as well. But reach out to Kendra. She's the guru on the US state side.
The question in relation to super again. So if you're taking distributions from your super, how does the US tax it? Do you get to withdraw the cost basis first and then pay no tax on the distributions? Then once the basis is used up, the US would start to tax the gains, or is it done proportionally?
Yeah, the way I've seen it done is proportionately. There are probably other accountants that have a different viewpoint, as long as it's a reasonable argument that can be made in front of the IRS. But yeah, I've seen ratably or proportionately.
So current US citizen living in Australia, if an Australian spouse transfers some of their current super to an American spouse, what are the tax implications? So I'm assuming that is a spouse contribution. I think the only reason why you would potentially do that is if the American spouse was older and you get access to it more quickly. Otherwise, I don't know that you would transfer it, because keeping it in the Australian name keeps it very, very clean from a tax perspective. But tax treatment in that strategy, Kendra, what would?
I have to admit that is not something I've seen frequently, maybe only once or twice. And so I'll cushion that by saying, again, opinions may vary depending on who you speak to. I think I would look at that as a personal contribution, again, comparing that to overall employer contributions. Could it lead to a foreign grantor trust issue? There potentially is some gift reporting involved in that transaction as well.
Right, thank you for that. So question, if you're a joint citizen and have a Roth in the US, should you wait until you return to the US to take the money out, not whilst you're living in Australia? Brad, maybe do you want to?
Yeah, thank you, John. Yeah, I think we should have touched on that before, just quickly, in that Australia it doesn't recognize a Roth IRA treatment in Australia. So although it probably would be tax-free in America, it will be taxable in Australia on the growth component of the Roth IRA. So yeah, obviously by leaving Australia, becoming a non-tax resident of Australia, it would not be subject to Australian tax. But I guess maybe before that step, you could just do some calculations to work out how much tax we would pay in Australia on that withdrawal. Because as mentioned, the Australian taxable component is only the growth of that Roth IRA after the rollover date normally. So it may be that the Australian growth component is not that high, and the taxes can be managed accordingly. So yeah, I think best just to get some advice and do some calculations on that.
And then there's a question about contributing to a Roth with US dollars if you live in Australia, whether that's an effective strategy. Brad, maybe if you want to continue on the Roth discussion.
Yeah, thanks, John. Yeah, it's a good question. I mean, I guess it's certainly not as effective as putting money into super, because that money that goes into super would be a pre-tax deduction to lower your Australian taxes. So there's been no deduction on the Australian side for money going into a US plan, including a Roth IRA. Having said that, there could be some merit in doing it still, if the goal was to go back to America and retire, for example, or you had post-tax income. So, cash savings you wanted to put into a retirement plan, there could be some merit in doing that still. But certainly not quite as effective as putting money into your Australian super.
Yeah, great, thank you for that. And then there's a question about a strategy for a dual US Australian citizen living and working in the US but wanting to retire in Australia. So it really depends on circumstances, but ultimately, we mentioned about the 401k and IRA, so if you're still employed, and especially if you're on a higher tax bracket in the US and you get matching by your employer, it makes sense to contribute to the US retirement pool. But I would say, definitely it usually won't stack up to, unfortunately, contribute to your super in Australia because of the way the US will potentially treat that. But it is worth considering the currency exchange side of things, as I was mentioning earlier, and potentially repatriating some money if there's a deal to do so, and getting it to Australia, just to hedge your bets in terms of the currency, especially where it sits right now. We're at 65 cents. Looking at historical standards, it's the average is closer to somewhere in the sort of low 70s. So we don't know what it's going to do in the coming years, but right now, just judging by history, is not a bad time to be getting money home and getting it into Australia if you're going to have Australian dollar spending in retirement. So it's it doesn't have to be all or nothing. It can be having pots of money, some in Australia, and just hedging against the possibility of a stronger Australian dollar and being stuck, and being able to utilize that money when the currency's strong, the Australian dollar, and you don't want to be pulling money from the US and still having the US retirement savings. But it's going to depend on circumstances that we can certainly talk you through. Guys, did you have any other things to add on that query, or?
Yeah, I think that's a good summary, John. I would just add, obviously just be mindful of investing in the Australian mutual funds to avoid those US PFIC rules. So just conscious that any Australian mutual funds or ETFs will be caught up in those nasty US rules. So perhaps stick to the US stock market in that context. Just be mindful of putting money into your Australian super if you do come down here and retire. But otherwise, agree, John, with what you said.
And then having a US address when receiving US social. You have to have a US address when receiving Social Security benefits while living and retiring in Australia. Knows the answer. Ultimately, you can receive that, and many Australians will receive from Australia and an Australian address. You go through, funnily enough, the Manila office to apply. You can go through Services Australia, but it's all done through the Manila office, which is the US Social Security office for the Asia Pacific. Next question is, so Kendra mentioned de facto relationships treated differently. Can you expand on that discussion?
Yeah. The IRS makes a definite distinction between a married couple and they don't acknowledge de facto relationships whatsoever. The difference is when you're making a gift. So if you are making a gift, so if you're a US citizen or a green card holder and you're making a gift to a non-legal spouse, there's an annual limit every year. I'm going to call it 17,000 US dollars, but it does change all the time. So if you made a gift to a non-spouse that exceeded that amount, you would need to file a gift tax return. Very unlikely there'd be any tax associated with that, but there is a reporting requirement. However, if you're a US citizen who is legally married to a non-citizen, that gifting limit, it's over 150,000 US dollars before it would trigger a reporting requirement. So yeah, that's just one more example of how the IRS is a little bit probably outdated on these topics. Yeah.
Yeah, perfect. And there's a question here about how is retired status defined? That means in relation to superannuation, potentially, and the access to that, which is typically if you're between the ages of 60 and 65, I believe it's if you're working less than 10 hours a week, then you can potentially trigger a condition of release of super and be seen as ultimately retired. Is there any other distinctions in the US or that side of things, Canada, the tax side of things? I don't think.
I'm trying to remember the definition. I think it's like over 59 and a half, separated from service, or totally disabled, I think is the definition.
I think that's right. Yeah. I think we've answered the state-based theory.
Yeah, I can quickly touch on Andrew's question on the life insurance
Right.
policy.
Yep.
Yeah. So effectively, Australia does offer some concessions for qualifying life insurance policies. So if you hold that policy for 10 years and the contributions to that policy have been consistent over that 10-year period, then a withdrawal would normally be free of tax in Australia on those policies. So normally good news on a life insurance policy if you're living in Australia. On the US side, yeah, maybe Kendra, do you have any comments on that?
Well, my only comment is that, of course, it's really complicated. I think the US definitely has rules around foreign insurance. Quite often they're sold as insurance policies, but are actually investment portfolios that usually contain PFICs. And so that can add quite a bit of complexity. US insurance policies, generally are going to be fine. It's just when there's a foreign component involved.
Thank you. Are there any stipulations around moving non-retirement investment funds between countries? It'll be more capital gains tax.
Yeah. So I guess on that one, yeah, from a tax perspective, there's no limit on the amount of cash you can move between countries. This whole $10,000 thing is somewhat misunderstood sometimes, I think, and that applies to the banks to report transactions coming into Australia of more than $10,000. But you can transfer, cash or funds above that amount. There can potentially be tax on any foreign gains or losses in Australia on large amounts of cash coming into Australia. But yeah, normally you can move funds around with no sort of limits. But as John mentioned, very much mindful of any capital gains or income taxing points that might arise. Yeah.
Yeah, and really good question here in terms of the foreign tax credits and the best strategies to utilize foreign tax credits as a US Australian citizen. So Kendra, maybe that's a good one for you.
Yeah, we didn't really talk about it very much, did we? But in addition to sort of this idea of creating a cost basis for US tax purposes where the money that's been taxed once can't be taxed again, we do try to use a foreign tax credit strategy. So everyone is probably aware the top rate of tax in Australia is, let's call it 47%. At the moment in the US, it's 37%. If you're working in Australia and paying tax at 47, that 10% differential is what we call a foreign tax credit carry forward. And those carry forwards last for 10 years. So quite often, someone who's worked in Australia, who's getting closer to retirement age, they can have tens or hundreds of thousands of dollars of foreign tax credit carryovers sitting on their tax return waiting to be used. So the idea is looking for strategies. Is it actually possible to take a large amount of superannuation into income during that 10-year period and utilizing those foreign tax credits to reduce the amount of US tax payable? Yeah, absolutely. It's going to be so dependent on each individual, how they've been reporting things along the line, what their tax rate is in Australia, but definitely a good strategy if you've got those carry forwards kicking around.
Yeah, beautiful. Susan mentions I'm an American living in Australia now, an Aussie citizen. I need to start making a transition plan for retirement, as the majority of retirement income is in the US and a smaller amount in super in Australia. We need to think from a tax reporting standpoint, i.e. how do I report, pay much tax? Do I need to plan on paying on withdrawals from the US IRA, and how do we plan for how much we need to draw to live on, taking into account how much we need to end up paying in taxes in both countries? I feel like I need a consultation with both a financial planner and an accountant who understands both Australian and US taxes. Do your companies work together, and do you offer joint consults to develop a plan? And do you work with clients in Western Australia? So we definitely all work together, and we will do joint consults for sure, and we quite often do with our clients. So we do work collaboratively together and come up with a consistent strategy. In terms of our services, we put together strategies, and then we're there ongoing with our clients and provide the ongoing support. Unfortunately, it's really hard for financial advisors to do ad hoc work, but it's certainly something that if you were looking for a financial advisor and a US accountant and Australian accountant, Brad and Kendra and I do that for a lot of clients and do it, really effectively.
Yeah, and definitely in Western Australia or anywhere else in the country, or abroad as well, anywhere in the US.
Sure.
We have clients in the US and we all do, and all parts of Australia, and we're happy to look after anyone. These video calls these days make it very easy to look after anyone wherever they're residing. So we're more than happy to look after you. Don't have to be a Melbourne based for sure. But we're probably getting to there's a lot of questions coming through, which is fantastic, but probably getting to the end of the session, I think. There's a quick question about PFIC, which I might very quickly what it is. It's basically any and this is a US tax term, any non-US indirect investment. So, if you were to buy an Australian Vanguard exchange traded fund or a managed fund that's domiciled out of Australia, that's triggered the PFIC treatment. A direct stock, if you bought Commonwealth Bank shares or if you bought Telstra shares, they're typically fine from a US tax standpoint. So you've just got to be very careful what you invest in outside of the US. You can do what you like for anything US domiciled, would be, I guess, the answer from a US standpoint. So that's the considerations there. Does that anything to add to that, Kendra? Or
I think that's it exactly. I mean, there's a lot of technical rules that the IRS would apply, but I think the easiest way to conceptualize it is this concept of mutual funds. And there's just so many in Australia. They're almost hard to avoid, as you know, John. They're very popular here. But it's just a matter of looking and trying to find out where this thing is domiciled. If it's in the US, you're golden. If it's not the US, unfortunately, it leads to additional filing requirements on the US tax return.
Yeah, perfect. And maybe do two last questions if
just quickly, John. I saw one from Matt just regarding his property sale and the Australian tax treatment. So Yeah, so unfortunately, Matt, Australia hasn't got a similar concession like the US where you can do a rollover and avoid CGT. But it might be good news in a couple of points. The property would get rebased to its fair market value when you got PR and moved to Australia. So you're just paying tax on the growth after you got PR in Australia or moved to Australia. And secondly, you can still apply the Australian main residence exemption for 6 years after the property was first rented. So you can exempt, 6 years of that gain. So it may be actually relatively good news, but yeah, maybe just get in touch. Matt, just drop me an email. We can have a chat on that one. There was a question there from Victoria on crypto assets getting rebased when you come back to Australia. Yes, for sure. That crypto assets also get rebased their fair market value when you recommence Australian residency, which is good news. And a question from Matthew on the new proposed Australian tax residency rules. Great question. And no, nothing more on that front. I think everyone's waiting in anticipation. I think there's obviously a budget in a couple of weeks, so we might hear some more news on that rule then. So definitely watch this space. It's a really good question. Yeah.
Right. And sorry, very last question. I think this is a good one. So are there any obvious considerations for self-employed people regarding retirement planning, or is it effectively the same as an employee or very dependent on personal specific circumstances?
Very dependent on specific circumstances. I think I'm imagining this question is like sole trader in Australia. And yeah, again, probably a big difference in opinion depending on which US accountant that you speak to about whether you should be potentially on like a payroll type of situation where superannuation guarantee is going into a fund, or whether you can make those contributions on your own and effectively be able to ignore it on a US tax point of view. I think it probably depends as well on your pre-existing superannuation, what's in there. So yeah, not an easy answer for that one, unfortunately.
No, perfect. Well, I think we've gone a little bit over time, but thank you to everyone that's joined. Hopefully you found the session informative. We will send the recording probably in the next week or so. Just give us a little bit of time to get that out. And also in that email, you'll have contact details for all three of us if you want to reach out and have a discussion about your situation and see if we can help. But thank you for joining, and have a great evening if you're in the US, and a great day you're in Australia, and we look forward to speaking to you next time.
Thank you. Thanks, everyone.
Yeah, thanks, everyone.